Hey, it's Demetrius. Welcome back to the channel. And if you've been researching whole life insurance or overfunded whole life insurance for any meaningful amount of time, you've probably come across the term paid up additions, or just PUAs for short. And you may be trying to wrap your head around exactly what that means for you, what it means in general. And if that's the case, you've come to the right place, because in this video, I'm going to answer a few questions, 5 in particular, that revolve around specifically the paid up additions rider in whole life insurance. So I'm going to answer specifically what is the paid up additions rider, zoom out a little bit more so and ask, what are paid up additions? Why do they matter? How do they work? And then how are you able to turbocharge your cash value in a whole life insurance policy because of these? And so if you're in deep research mode, you want real clarity, you want that clarity without the additional unnecessary fluff and hype that you may see on social media, you're going to want to stick around all the way to the end, because even if it sparks new questions, I think that's great. That's what the comment section for, and I'm here to reply to any comments that you have about it. Or I could even just go ahead and make another video. If you find it valuable, I could always do that as well. So at least in this video, you're going to walk away knowing exactly what the paid up additions rider is, how it affects your policy, or how it affects potentially a future policy you're looking to get. So without further ado, let's jump into it. So I always think it's helpful to just kind of zoom out. Let's start with the basics in and of itself, okay? Paid up is a term that you don't hear too often, but it's often used in the whole life insurance world. It's a weird insurance word that simply means fully paid for. And in this case, what's being fully paid for is a chunk of permanent whole life insurance death benefit. And so when I talk about things like paid up additions, I'm literally referring to small pieces of whole life insurance that are being fully paid for the moment that they enter your policy. And so the result of adding more than what's required to your policy means that the premiums used to buy those paid up additions are going directly to your cash value. More specifically, a small sliver, just a small sliver, is being used to buy fully paid for death benefit, while the rest is going to cash value, right? And so in a literal sense, it's doing two things at the same time. And for high cash value whole life policies or overfunded whole life insurance policies, it's the main driver that you have the most control of within your policy, meaning that you can dial those premiums upward, you can dial them downward, however you wish, depending on how it was originally set up from the very beginning. It's what you have the most control over. Now, as a quick distinction, I figured I'd talk about the difference between the rider itself and the paid up additions, right? So the paid up additions rider, when it comes to what a rider is, it's ultimately an optional feature that you can add on to a policy to allow it to do something that it would not have otherwise been able to do. And so without the paid up additions rider, your ability to take your dollars and buy more paid up additions really isn't there. But when you add the paid up additions rider, you're able to do so, or at least do so in larger amounts within the policy. So think of the rider as the optional feature. It lets you purchase paid up additions, and then the paid up additions themselves are the actual chunks of fully paid for life insurance, whole life insurance, which is the result of using the rider. So think of it this way. The rider is the mechanism or the enhancer, whereas the additions are the result of using said rider. Hope that makes sense. So the big question is, why do paid up additions matter? Like, why do they matter so much? And so the short answer is this: they dramatically increase and accelerate the growth of your cash value. And so in fact, most of the overfunded policies that you've seen or that I'll show on this channel over time, these are properly designed whole life insurance policies, right? They're made up of mostly paid up additions. In other words, there's a total amount of premium that you may see on the ledger. Most of that is actually made up of paid up additions. So without paid up additions, and more specifically the paid up additions rider, your cash value is going to grow. And I'll show you this in a moment. It's going to grow, but it's going to grow a lot more slowly. It's going to grow very slowly. But with the PUA rider, and even a modest amount of PUAs, you start seeing meaningful growth faster in your policy. And when you maximize paid up additions, that's when the policy really starts to compound and do so more quickly in your favor. So let me show you 3 real examples. The first example will be no PUAs at all. It's going to have the slowest growth with the most base premium. Then I'm going to show you a policy with some PUAs, right? Not a whole lot, but it's going to show you some PUAs. It builds better early cash value for sure, but it's not as optimized as it could be. And then I want to show you a policy with maximized paid up additions. This one is showing you higher early cash value, optimized for liquidity and long-term growth. So let me go ahead and hop right on into it. So the policy that you see here on the screen, we're showing $30,000 per year. And by the way, I'm going to show you the same amount of premium outlay in every single one of these policies going forward in all three examples. So all of them are going to be $30,000 per year. All of them will stop premiums by the 21st year. And all of them are for a 35-year-old male at a middle of the road preferred or second best health rating. Okay. And so $30,000 goes into this policy. And then this policy in particular, there is literally no paid up additions rider that's incorporated within this policy. And so $30,000 goes into the policy. And from a cash value perspective, what you're going to notice is that there's $0 of cash value in that first year. And so the next question that comes to mind for a lot of people is like, well, I see that there's cash value happening. So, well, at what point does my policy break even? And so from there, what we're going to want to look at is the cumulative premium outlay. In other words, what is the total amount of premiums that I've contributed to my policy from day one relative to how much cash value I have? So the question we're trying to answer is, at what point does your cash value equal a number larger than what you've put into it in total? And what we're seeing is by the 11th year, you've put in $330,000 into the policy in this example. And that's when you finally have $334,000, a little bit more cash in your policy than you've actually put into the policy. Let's take a look at another example here. Within this example here, again, we're showing $30,000 per year. The difference is, instead of all of that $30,000 being due every single year, $20,000 of it actually makes up that base premium or that minimum premium, right? And so what we're seeing here is that 30 grand goes into the policy. You have a lot more cash value available. We're looking at $16,108. And then from a break-even standpoint, what are we seeing? We're seeing that this policy is breaking even by the 9th year. So by the 9th year, you've put in $270,000. You now have access to $279,000 by that point. And so by the time you get all the way to year 20, what we're seeing here is 600 grand has gone in, $930,000 available in your policy by that point. Shifting gears one more time, what we're seeing in this one is a policy that's, again, $30,000 per year. The difference is it's maximized for paid up additions growth. So the minimum premium in this particular policy so happens to be just under $5,500 for the year, more specifically $5,467 for the year. And so you're noticing a lot more cash value even in that first year, almost $25,000, just $3 shy of that in that first year. This policy ends up breaking even in that 5th year. So $150,000 has gone into the policy, and you have access to $151,655 by that point in time. And when you fast forward all the way down to 20 years down the line, $600,000 has gone into the policy. You have over $400,000 more available within your policy by that point in time as well. Not to mention that your death benefit has also increased, but that's not necessarily the point of this video. So going back to the very first one that we looked at, 600 grand goes into the policy. By the 20th year, you have access to $892,000. When you look at the second one that we look at, $600,000 goes in, you have access to $930,000. And then of course, the last one that we looked at, $600,000 goes into the policy with about $1 million, a little bit over $1 million available in your policy by that point. And something else that I think is really important to note here is that when you look at this section of the illustration called a premium breakdown, you can get a feel for how much of your $30,000 is going where. Okay. And so what you'll notice here is that the base contract premium is $3,254. The flexible protection rider is what they call it at this carrier in particular. This is Penn Mutual. The flexible protection rider, it's their name of their term insurance rider. It's a blended term insurance rider. That's $2,214. EPPUA rider, it stands for Enhanced Protection Paid Up Additions Premium. That's $24,000. And all of this column, this EPPUA column, all of this premium is, you guessed it, optional. In other words, you don't have to contribute that. You have a lot of wiggle room. So on the low end, you're looking at $5,500 in any given year, all the way up to $30,000 is what you can contribute within this particular policy. But the main thing that I want to mention here is that because of the fact that you have so much paid up additions going into the policy, that's what jumpstarts your cash value early on in your policy relative to how much you're required to pay out of that 30,000. If we shift gears here, what you're seeing here for the one where there's some paid up additions, what we're showing is that there's $10,000 worth of paid up additions here. And just know as a tangent, even all base policies, as you probably already noticed, does start to generate some amounts of cash value. Won't get into the specifics of that today, but with the smaller amount of paid up additions, that's why you're noticing that the amount of cash value early on and long term is just a little smaller in this policy. Whereas when you take a look at this one, we're looking at the same type of page, what's called the basic ledger page at this particular carrier. There is no base, FPR, and paid up additions columns. It's just base premium. And so this is going to be your total premium that you have to contribute every year, no matter what. And when people look at, even with the quote unquote non-guarantees, when people see policies like this may be a reason why some people go, you know what? I thought whole life insurance was a terrible place to put your money, but it all boils down to how you use it and how you have the policy structured from the very beginning. So having more paid up additions going to your policy, like you're seeing here in this particular case here, the greater your cash value will be. Policy like this one, if someone doesn't know any better, they see $30,000 per year, that's your minimum, that's your maximum, they look at that and go, this is the reason why whole life insurance is a terrible place to put money. And I actually would have to agree with them, especially if the goal is to accumulate cash over whatever period of time. And so if you have $30,000 you got into a policy, you got $0 to start off with, that's a tough pill to swallow. Whereas if you put that same $30,000 in, have access to a significantly higher sum of cash, you have a death benefit that's growing for the rest of your life, which isn't necessarily the point of this video. What you're finding is there's just a lot more liquidity that you have, better growth long term, all because of the fact that more paid up additions were going to the policy. That's the importance right there of the paid up additions rider. With the examples that I shared, in a nutshell, that's ultimately why paid up additions riders exist to begin with. But a question that some people ask is like, ultimately, besides that, why is it that paid up additions exist in the first place? Like, why are they there? Have they always been that way? And all that sort of stuff is a good question to ask. And the whole idea behind it and the origin story behind it, it really gets into the weeds of like tax law and the modified endowment contract and all of that. But here's the gist, okay? Paid up additions became the structured way to let people add more money into a whole life insurance policy without turning it into a MEC or a modified endowment contract. Because when it turns into a MEC, it removes a lot of the tax advantages that you would have otherwise had, especially as it relates to the cash value in and of itself. So in other words, the PUAs are a tool that gives you the flexibility to build cash value and permanent death benefit while staying compliant with IRS rules around life insurance and the definition of life insurance specifically. And so here's the big takeaway, okay? If you're looking to use whole life insurance as a way to grow long-term wealth or to store cash more efficiently than perhaps a savings account or other safe places to store money, then paid up additions are going to be your friend, especially again, if you're looking at whole life insurance. They are the reason high cash value policies work in the way that they do. They are what let you front load premium and put a ton of capital inside of your policy. And they're one of the biggest levers that you can use to customize your policy based on your goals. And even if life changes, you can kind of toggle your premium up or down as needed. So I hope this video helped you understand what paid up additions are, how they work, why they matter. And if you still have questions, go ahead and just drop them in the comments, or you can check out the free PDF I put together on how overfunded whole life insurance works. The link is in the description or the pinned comment. And as always, if you want help designing a policy the right way, you can always schedule a call with me directly at any time. So thanks for watching. See you in the next one.